All right, let's talk about a huge step for any business, buying your own property. It's a massive milestone, and the mortgage you pick, well, that's the key. It can be the very thing that unlocks incredible growth. But get it wrong, and it can be a serious threat to everything you've built. So, the big question is, how do you pick the right key?
So, picture this. You found the perfect spot. Maybe it's a new office, a warehouse, that dream storefront. It's a huge sign that you're growing, right? But here's the thing. The most important decision you're going to make isn't about the property itself. It's about how you choose to finance it.
And really, the stakes could not be higher. We're talking about a loan that can completely strain your cash flow and put everything you own at risk. But you know what? Just understanding your options is the very first step to making sure that doesn't happen.
Okay, but let's flip that around. Because if you choose wisely, a mortgage isn't just a pile of debt. It's a strategic tool. It's something that can actually unlock growth and fast-track your plans. The secret, the whole trick, is matching the right tool to your specific business.
And to help you do that, we're going to break down 3 of the most common financing tools out there: the adjustable rate mortgage, you'll hear that called an ARM, the balloon mortgage, and the home equity line of credit, or HELOC.
First up, let's talk about the ARM. I want you to think of this one as kind of like a roller coaster. It starts off nice and smooth, really easy, but you have got to be prepared for the twists and turns that could be coming down the track. It's a calculated gamble for sure.
So what is it exactly? Well, an ARM is a loan that starts you off with a fixed, and usually pretty low, interest rate for an initial period. Let's say 5, maybe 7 years. But after that time is up, the rate adjusts based on whatever the market is doing. It could go up or it could go down.
And that brings us right to the core trade-off of an ARM. The benefit, it's pretty obvious for a growing business. Those lower initial payments mean more cash in your pocket for things like inventory or staff. But the risk is what's called payment shock. If market rates shoot up, your monthly payment could jump a lot and really strain your budget, kind of out of nowhere.
So who should take this kind of gamble? Well, an ARM can actually be a brilliant strategic move if you have a clear exit plan, like if you're planning to sell the property before that initial fixed period is even up. It also makes a ton of sense if you're really confident your business revenue is going to grow enough to easily handle any potential payment increase. It all comes down to your timeline and, honestly, your stomach for risk.
All right, next up, the balloon mortgage. Now, if an ARM is a roller coaster, you should think of this one as a ticking clock with a very, very dramatic ending.
The whole structure is pretty unique. You get these really low monthly payments for a set term, usually 5 or 7 years. But, and this is a huge but, here's the catch. At the end of that term, the entire remaining balance on the loan is due, all at once in one giant, massive payment. The upside here is all about maximum short-term cash flow. I mean, your monthly payment is minimal. The risk, though, is enormous. You are essentially staring down a financial cliff, and you absolutely must have a concrete plan for how you're going to handle that massive final payment. And just to make this super real, imagine this. For years, your payments have been totally manageable. And then, bam, you get a bill for $750,000 due in full right now. If you don't have a rock-solid plan to pay that, you could lose everything. It's a powerful tool, no doubt, but wow, it demands some serious preparation.
Okay, our third tool is a little bit different. Unlike the others, a home equity line of credit, a HELOC, isn't for buying a new property, it's for leveraging a property you already own. Think of it like a rechargeable power pack for your business.
So a HELOC basically lets you borrow against the equity in your property. You know, the difference between what your property is worth and what you still owe on it. It's not a one-time lump sum loan, it's a revolving line of credit that you can draw from and pay back whenever you need to. The huge advantage here is flexibility. You've got cash on tap for whatever your business needs, and often at a way better interest rate than a credit card or some other loan. But the risk is just as real as with the other loans. Your business property is the collateral. If you can't pay back what you borrow, you could lose the physical home of your business.
And, this flexibility is exactly why businesses use HELOCs for so many different things. We're talking about covering payroll during a slow month, renovating your space, funding a big expansion, or even just buying a bunch of inventory in bulk. It is an incredibly versatile way to get capital.
So, there we have it. We've looked at 3 very different financial keys: the ARM, the balloon mortgage, and the HELOC. Now comes the most important part, figuring out which one of these actually fits your unique business plan. Here is the crucial takeaway from all of this. There is no single best mortgage. It just doesn't exist.
And anyone who tells you there is, well, they're not thinking about your business. The right loan is the one that lines up perfectly with your goals, your timeline, and your personal comfort with risk.
Let's just lay it all out one more time. Look, if you're planning to sell that property in less than 7 years, the ARM is literally designed for that situation. If your number one priority is the absolute lowest monthly payment you can get and you have a bulletproof plan for that final payment, the balloon might work. And if you already own property and what you need is flexible cash, the HELOC is your go-to tool. Look at the biggest risk for each one and ask yourself honestly, which one is my business best equipped to handle?
And that brings us to the final, crucial question, the one only you can answer. It's not about finding a good loan. It's about finding the loan that your specific strategy demands. So, are you playing a short game? Are you building for the long term? Do you need stability more than anything? Or is it flexibility you're after? Your answer right there? That's what's going to tell you which key you need to unlock your future.